Thank you very much for the invitation. It's a privilege for me to be here to discuss with you about the challenges, because we are talking about challenges, real challenges, in being and playing in a high capital-intensive sector like infrastructures in this time. I mean, we are not like banks that can raise a flag asking for money, lending or whatever, because they are too big to fail. Infrastructure players are exposed to the same risks as banks, but they are not too big to fail. This means that issue of financing, issue of sustainability, issue of refinancing is something to be taken very seriously in this sector. Before to enter into a more specific answer to the question asked by Mr. Sen, let me give to you a brief introduction about what we are. Okay, highlights, we are not just Italian. We are investing in Chile, Brazil, Poland, and India. So we are exposed to a wide variety of, and France as well. We are exposed to a wide variety of legislations, of attitudes, of growth, of natural resources, or whatever. And cultures as well, of course. We are not present just in building roads, but we are present also in technological fields. For example, we are setting up the system for heavy vehicles tolling via satellite system in France. It's a 3 billion contract we won against French players. It's quite interesting and rewarding for us. And we have the highest credit rating in the sector in the world. And it's not so easy if you consider that rating agencies tend to blend and mix more and more national and country risks with operational and business risks. So this rating is the highest in the sector, but was even higher before downgrading of Italy a few months ago from S&P. So we are exposed heavily with no possibility to, let's say, mediate to all decisions taken by rating agencies on the country of Italy. So sovereign risk is something we will address later on in this presentation. This is the chart. Doesn't add anything to what I said. Let me talk about what we do in Italy. We are not building greenfield projects. For a simple reason, our view about the sector is that Italy has developed industrial platform in the 70s, 60s, 50s. All the network is already there. What's missing is capacity of the network. So what we are doing is adding capacity, adding new lanes to already existing roads. And we believe that what we need in Italy is now to add capacity, create efficiency in transportation, especially in the Milan area, you know very well. And you know as well how efficient can be a small investment like what we did in Bergamo, between Bergamo and Milan. Now there is no problem of capacity anymore with a very limited investment. Let's say with an investment which is 1/10 of the investment to build a new road between the same cities. But nevertheless, 21 billion for 10 years is a huge investment for a private player mainly exposed to one single country in the Mediterranean area. So it's quite challenging. We already did 7.5 billion euros in the recent years. We are growing 20% year on year our CapEx spending. We are spending right now 1.7 billion euros, last year numbers, more than the free flow from operations. So we are increasing that every year to finance the bottlenecking on roughly 900 kilometers of toll roads. And it's challenging also if you consider comparison with the other two big giants in this sector in the world. All the giants in this sector are European. One is Abertis, and the other one is Vinci, together with Atlantia. We have the best rating. We have the lowest leverage. It's not in the slide. And we have the largest CapEx spending per year. Our 2011 pro forma is more than the sum of Vinci and Abertis together. So funding this kind of investment plan is something that occupy my working days and some time also my
at night.
Yes, some nights. And the last comment about what we are and what we are doing is that most of that plan has been negotiated after privatization, and that negotiation has been driven and supported by the sharp increase in efficiency for the company. And now we have more or less the same ratios we had in the company had before privatization in '99, but thanks to the fact that EBITDA is more than double, at that time we can sustain a much higher CapEx plan than before. So efficiency and profit drives CapEx plan, and this is the name of the game in brownfield investments. The more efficient is the company, the lowest is the cost of capital, driven by cost of debt, cost of equity, and the regulatory framework, and so on and so forth, the highest the investment plan can be, in order to keep rating and ratios. But I mean, in order to stay in the 15 minutes given, now I would like to emphasize the key points I have in mind. First is about infrastructures in general. I believe that Keynes is not working anymore in a developed country like Italy. So the infrastructure is a mean and not an end. And the selection of infrastructure is key. When the European community talks about TEN-T, so the big corridors from Lisbon to Kiev, is talking about something that is, the best we can say, conceptual. There is no truck driving from Kiev to Lisbon, and what's missing in developed countries like Italy is capacity and quality of infrastructures where the work and people lives. Big cities, not a corridor, big cities, big nodes. And what's missing in Italy is proper infrastructure for tourism, because for sure we can miss some market shares in manufacturing, in mechanics and so on, but we can defend our heritage in culture, touristic areas and so on. And probably also European community should try to help Italy in, let's say, allocating in a more efficient way probably some resources from Europe. Because if resources are just for TEN-T, most of that money will not be at work as it could be if invested in airports, subways, and so on. This is the first point. Second point is about how feasible is what we hear about CapEx plan, 100 million, 100 billion, trillions, and so on. Because, I mean, we are in competition in the world. If we, as Atlantia, Autostrade, invest in Chile, also Canadian pension funds, German pension funds, Middle East pension funds and sovereign funds can invest in those countries. And the number of investable countries is much bigger now than 20 years ago. 20 years ago, there were probably 20 countries where money could have been invested with some safety. Now it's probably more than 100, 150, so competition is fierce. And of course, in order to attract money, we need to have lower operational risks. One of the risks is demand risk, is traffic, is consumption, and it's not easy to imagine that the future of demand in Italy will not be impacted by sovereign risk and what will happen to Europe. It's about CapEx risk, capital expenditure. This is totally impacted by, let's say, administrative efficiency. Now in Italy, as has been said before, there is a very poor project management and administrative efficiency. One example for all, tendering of new project is done on the basis of preliminary design, not final design. So it's based on something that is not binding. I mean, it's very easy to understand that you cannot give a contract on something that is not binding. But it's happening in Italy. And this is why we are losing a lot of money in negotiating afterwards modifications to the contract. And last, no, not last, regulatory and contractual risk, we said, are two different topics. One is regulatory, which is new laws, new taxes, and Italy has not a good track record. And the other one is contractual risk, is, let's say, enforceability of contracts. Because if somebody invests, it's on the basis not of the law, but is on the basis of a contract, something that cannot be changed by law. And here again, history of Italy is not, let's say, fault-free, and quite recent, unfortunately. And this is a new entry. What we will do in Italy will depend a lot on something that is a new entry as a risk, which is sovereign risk. We have seen something and a lot of charts about rating. You know that most of rating agencies have a policy. No initiative in a country can have a rating higher than the sovereign risk, than the country itself. Meaning that it's sufficient to have a downgrade of Italy, of Spain, of whatever country, to put immediately in the uninvestable basket all the project bonds or corporate bonds issued. Because as you probably know, all the sovereign funds or pension funds in Northern Europe cannot invest due to bylaws in bonds below A+, A-, triple B is the minimum limit. Meaning that sovereign risk can impact a lot. Not only, let's say, feasibility of bank financing, that was the main way to finance infrastructures in the past, but also feasibility of project bonds, perception of demand risk, and so on and so forth. I stop here, but I mean, you can imagine other kind of risks related to sovereign risk. Meaning at the end that my feeling is that the reduction and the management of sovereign risk cannot be driven by investments in infrastructures and subsequent growth for a simple reason. Investment is not viable without a substantial and stable reduction of sovereign risk. So sovereign risk and growth should be addressed in parallel. If are not addressed in parallel, growth without management of sovereign risk is not viable, or at least is not viable in big sizes. Of course, we will continue to invest. We are big enough and solid enough to, let's say, stand in front of a deeper crisis, but is not the case for most of project bonds, projects, greenfields, and so on. So I believe that we need to address the two problems in parallel and be very selective. Not all the money will be available, meaning that we need to choose very carefully the projects where we want to invest. Otherwise, we risk to, let's say, target too many things, too much money, and we will not succeed. This is my feeling and my contribution to this workshop. Thank you.